Okay,
There
great. Well, I'm Myrna Grawn. I'm the Executive Director of CARE, and we've been starting these CARE Connect sessions last January, and they've had great, or maybe the first one was in February, but they've had really great success. And so we're kicking them off for the fall again, and going to be doing another big lineup from January till April. But today we have with us Farm Credit Canada. You'll learn a little bit more about them in a bit. I just wanted to take you through our team. So obviously myself, Jordan Sisiwa, is our Marketing and Industry Relations Manager, does all of our social media. We have Diana Svensson, who joined us as our Office Administrative Coordinator. Lisa Siragusa, who is our Member Relations and Training Manager. She manages the CARE Connect sessions, as well as running the behind the scenes of these sessions, but also the training program and the member relations. Tracy Shelton's our Convention Manager, which is conventions coming up. And Juliana Grawn is the summer student and is continuing to run all of our newsletters and our databases that hold everyone's information and manage sort of those contact lists. We have our board of directors listed here that you can see, and Mark Davies joined us today. So thanks, Mark, for joining in. And if we go on to the next slide, we have our CARE Connect, or sorry, our CARE Convention, which is November 18th to the 20th in Saskatoon. It's our 30th anniversary. You can see the QR code here if you want to check out the lineup of speakers. Science of the Six Pack, which is a fun beer competition with the local craft brewers where you get to vote. They win a big sort of keg prize. Our 30th anniversary gala, our awards. If you know anyone who'd like to nominate for some of our CARE awards, some of your colleagues for Retailer of the Year, Supplier of the Year, Hall of Fame, and there's a couple of others as well. It is the early bird ending this week. So if you want to get in on that early bird pricing of $7.99 instead of $9.99 for members, it's your opportunity to do that. And the block of hotel rooms is given up next week. So it's kind of critical timing right now if you want to get involved in that event. If we go on to the next is our next CARE Connect session is going to be with Sharon Bauer. I heard her speak at the Tronia user convention. She is phenomenal as maybe privacy and ag business protecting trust like a crop is maybe one of those topics you think, oh yeah, that's going to be interesting. But she is a phenomenal speaker, and she also has really practical information for your day-to-day use of the data that you keep, but also your contact lists, your customer information, and how to ensure if you have a breach of any sort of magnitude that you can handle that, and you've put all the right practices into place. So Sharon's actually quite an amazing speaker on that topic, and really knows the industry and knows our ag retail industry as well.
And let me interject as well and let you know that for those who do attend the session, there's a privacy guidebook that will be sent out to those who are in attendance to next week's session or 2 weeks session.
Perfect.
All right, well, let's move on to today's session. But before we hear from Sarah and Steve, let's learn a little bit more about them. So first of all, Sarah Dobson is Senior Relationship Manager for FCC, leading the Input Financing Program. She works in conjunction with a territory relationship manager that supports your day-to-day business. Sarah grew up on a grain farm in southeastern Saskatchewan and loved agriculture all her life. She attended University of Saskatchewan, graduating with a degree in agriculture. And with over 23 years of experience in the agriculture sector, she has worked alongside retailers and growers, building relationships and understanding the unique challenges in this industry. For the last 5 years, she has been with Farm Credit Canada, where she has been focused on helping agricultural retailers develop financing tools and strategies to strengthen your business. And then we also have Steve Jobert. He's a territory relationship manager at Farm Credit Canada with over 20 years of experience in agricultural finance. He partners with Agri-Retailers across Manitoba to develop strategies that reduce credit risks and drive long-term business value. His approach emphasizes proactive relationship building and close collaboration with retail leaders and staff. Steve holds a business administration diploma at Red River College and studied at University of Manitoba. His career spans with producers, ag equipment, ag equipment dealerships, and input retailers, giving him a broad perspective on the industry. And outside of work, Steve is deeply involved with youth sports and community coaching, bringing mentorship and energy to every team he supports. So thank you for joining us, and I'll just turn it over to the two of you to continue on with the presentation.
Thank you very much. I'll just get it teed up here.
Excellent. Well, thank you, Lisa, for the introduction and for hosting us today. Steve and I are here today because FCC fundamentally believes in partnerships. In our role supporting our input financing businesses across Canada, you as our retailers are our valued partners. Our goal is to provide tools that enable your business success. And while you likely think of our partnership primarily through our input financing program, and we know this tool helps you manage risk and facilitate sales, we can be an even more effective partner when we are fully engaged with your business. By choosing to develop strategic relationships with our territory relationship managers, like Steve on the call here today, who supports your individual locations, we can identify those additional support tools for your business, whether that's economic insights, industry intelligence, or specific partnership tools that can help to support some of your key opportunities or challenges that you're navigating. So I want to encourage you to develop a trusted advisor relationship with your FCC representative if you're not already. When we understand your goals and what drives them, we're far better positioned to create solutions for your success. For those that work with FCC, thank you for choosing us as your partner. We couldn't support this industry in the meaningful way that we do without you. So today, I will be sharing a high-level economic overview of some of the current marketplace trends, and then I'll turn it over to Steve, who's going to spend some time discussing conversations around credit and farm financial health. So this is a look at Canada's GDP for the last number of years and projections out for 2025 and 2026. If we think of our Canadian economy, we generally think of our economy's potential as around that 2%. When we look at the forecast for the current year, 2025 and 26, we see the Bank of Canada forecast numbers on top, and then those FCC forecasts below, slightly different, but very close in range. If FCC is forecasting 1.1 for the 2025 current year, we would consider this, under the speed limit and a negative GDP. So looking at both 2025 and 2026, it really highlights how challenged our economy is. And we know that tariffs, among many other things, are putting pressure on the economy. If we take a look at Canadian inflation, we are still below the Bank of Canada's 2% target. Our August inflation numbers came in softer than expected, with headline inflation being that 1.9% year over year, although we did see food inflation move up to just over 3.4%. If we look at this data on a 3-month annualized basis, though, what we do see is evidence of a weakening core. And if you exclude food and energy, that 3-month annualized rate sank to 1.6%, the lowest that we've seen since 2024, February 2024. So what does this indicate? It indicates an economy with a widening output or / excess supply. When we look at the string of data that we have, we see GDP contraction in, second quarter of this year. We see a challenging labor market based on the first 8 months of this year. We have the lowest wage growth that we've seen since 2022 and a moderation in core inflation. Taking all of these things into account, I think we're seeing this information being reflected in some of the Bank of Canada's interest rate decisions over the last month. And so if we take a peek at what the Bank of Canada policy rate has done, they met last month and they reduced the overnight rate by 25 basis points, bringing prime to 4.7%. We know that the Bank of Canada will meet again in later this month in October and then again in December. FCC's current expectations are that we will see 2 additional rate cuts prior to the end of this calendar year. So estimating a total additional reduction of 50 basis points. And although we're seeing the short-term rates obviously take effect with these policy changes, we are seeing long-term rates holding steady at this time. Canadian loonie is always an important topic when we talk about agriculture. What you can see with this graph is that the Canadian loonie has strengthened due to a weaker US dollar, but not as much as other global currencies, which really highlight the structural issues with our economy and our challenges with exports. FCC's expectation is that the Canadian loonie will stay between that 72 and 74 cent range. Okay, bringing it a little bit closer to home in terms of what we're seeing out in the fields. This is a look at FCC's profit margin projections. We've got one on the left for canola wheat rotation, which is generally a little more indicative of Western Canada. And then we have our corn soybean rotation on the right-hand side of the graph, more indicative of Eastern Canada. When we take a look at these profit margins, we are analyzing them prior or before land costs. We know there's large variability in what our farmers experience for land costs, whether they are purchasing or renting, and of course, whether they, made those purchases more recently or a number of years ago. If we look at this graph, 2025-26 is the crop that we're just harvesting now, and last year's crop is still a forecast because not all the data is available. So summary, both in Eastern and Western Canada, is that although profit margins are going to be improved in 25-26 compared to last year, we're still very close to those break-even levels and well below the 5-year average. In Western Canada, we saw, in general, strong harvest yields, but coupled with soft prices, we're still seeing significant challenges in those profit margins. And Eastern Canada, due to some challenging weather this year, had some lower yields combined with some of those softer prices. In both cases, across Canada, we do see that profitability will be challenged. And our message to producers is that it's an opportunity to focus on productivity and efficiency, because those are things that will be very important going forward. Now, looking into 2026, we are currently forecasting that crop inputs are going to be very stable. We saw that blip in 2022, where we had stronger fertilizer prices coming post-COVID. They really have remained steady and stable, though. So although we're seeing softer grain prices, really our input costs are staying elevated going into 2026. And so with this information, FCC is currently, expecting a 6% drop in cash receipts for the current 2025 crop year, based on harvest projections, as well as the input costs that we saw. We do know that farm cash receipts vary by sector across provinces and regions, and therefore we are going to see some variability in terms of those mid-year farmland value results that reflect some of those regional differences. Okay. I want to talk a little bit about farmland values, just because they're usually pretty interesting and something we get quite a few questions on. FCC provides a farmland value report each year, usually in that early March timeframe, a synopsis of the previous year. So our last full year report came out in March of 2025, which reflected the 2024 farmland values. What we saw in 2024 was an average increase of 9.3% nationally, slightly below the 2022 and 23 years, but still very strong. If we look at the past 10 years, the graph on the right is showing the 10-year average across Canada. And I would say it's been very steady, if not robust, farmland value reports. FCC also produces a mid-year farmland value report, and that came out in early October for us. So looking at the first 6 months of the year, we saw that farmland values rose an average of 6% in the first half of the year. And if we look at the last 12 months, July of 24 to June of 2025, we actually see an average increase of 10.4%, which slightly outpaced the previous year's gains. What we are seeing is that those regional dynamics are definitely a defining factor, with pockets of strong demand and limited supply, driving much of the appreciation. We can see areas last year that had very strong increases, maybe moderating a little bit in the first half of 2025, and areas which may not have had as robust growth last year, we're starting to see them pick up in the first half of 2025. When we look at farmland values, we really see a few things that are big defining factors. The first one is obviously supply. We know that, supply of farmland is fundamentally limited, and therefore will always be a factor in, the prices that we're seeing. Although FCC did not see the range of farmland values change significantly, what we saw is the average price of farmland increased, and we're seeing that farmers are paying for that high quality productive land. Obviously, crop and livestock receipts also a big factor. Although crop receipts are have moderated the past year, we are still seeing very strong livestock receipts as a factor of driving that farmland values. When we look at interest rates, the lowering of interest rates do support more manageable carrying costs for farmland purchases, and it also makes investment in farmland more attractive relative to other options, other investment options. Looking back in kind of that short term, we saw that 2022 and 2023 were very strong, if not record years, for a lot of farms across Canada. And it's those strong balance sheets and equity positions that are still a significant driver of the increase in farmland values that we're seeing. So with that, that's an overview of some of the key economic trends that we're seeing in the industry, and I'm going to pass it over to Steve to continue the conversation around farm finances.
Thank you, Sarah, and thanks everyone for the opportunity to speak with you today. What I'm going to chat about here going forward is credit and some factors to consider when looking at credit, and also how FCC can best support your business. When we look at credit, really credit is an important financial tool that allows producers to efficiently manage their borrowing capacity while working towards maximizing their profitability. And we know that in our business, in our industry, it's unique because we know that cash flow is going to be higher typically in those fall, winter months when crop comes off. Ideally, it's sold, cash flow would be greater, versus in the spring where maybe expenses are at their peak. Into the summer where cash flow might not be as fluent. So we're in a unique industry with credit, and it really kind of ties into the importance of short-term credit for the producer to manage their needs throughout the year. Short-term loans are often used for operating expenses, and they help producers in the following ways. They can help your customer with purchases for seed, their fertilizer, and their other input expenses. It can help your customer gain access to pre-buys or potential rebates. It can help your customer take advantage of unexpected needs as they come up through the season. And it can help your customer funding their day-to-day operating expenses. But when we look at credit, there's also the emotional piece as well. That's not always discussed, but it's definitely present. And it really provides your customer with the financial safety net to help make decisions with confidence through the season. It can reduce stress. If they're working with yourself as a retailer, they have that credit set up in the background. That could help them towards making those purchase decisions. It can help give control and confidence to what their plans are for the upcoming year. And it could also position them for a growth mindset. If they're looking at expansion, or maybe they're looking at maybe spending a little more to maximize their profitability, it just gives them that control and confidence to make credit decisions or make a purchase decision that can best support their farm operation. So when we look at credit overall and short-term credit, what key factors are the most important to consider? So for sure, a credit bureau. So everyone on this call reports to the credit bureau. There's two main credit bureaus out there. There's Equifax and there's TransUnion. And what they do is they track credit card payments, your bill payments, different things like that, any sort of lending that you may have with the bank or FI. quite often would show up on that bureau. So it really gives a good sense of the payment trends for those customers over 7 years. Also, if there's any issues that come up, collections, judgments, things like that, that would also show. It creates a conversation with the customer to make those lending decisions when needed. And the other piece is farm liquidity. And what that what that means is it's the ability for the business to meet its obligations and continue to operate. So it's really the producer's first line of defense against disruptions to normal operations. So it covers short-term obligations such as bills, wages, and input costs. Again, definitely relevant in maybe June, July, August, where cash might not be as flush, and also supports flexibility and resilience. So an example could be the tractor breaks down, there's a big expense with equipment. Farm liquidity can definitely play a role into managing expenses as they come up. So as a retailer, when you're looking, if there's decisions made where you're going to offer that customer maybe in-house credit as a receivable, there's a couple of factors that we look at and that are important. Number one is working capital. And what that is that ensures that the farm operation has enough short-term assets to cover short-term liabilities. So we look at basically the calculation is quite simple. It's current assets minus current liabilities. If the difference is $1 million and they have 200,000 going to yourself, then they're obviously in a good spot. If that number is in a negative position, it would mean that they may have a challenge covering their short-term debt. And the key to this is it would need to be a current net worth statement. So you want to have something relevant within 30 days. The current ratio measures the farm's ability to pay short-term obligations or those due within a year. And that's your current assets divided by current liabilities. It's going to give you a number. We look at 1.25 as a sufficient number to show that the grower can support their finance needs over a 1 year period of time. So really comes down to understanding your customer's current financial situation. So as I know everyone on the call, you're visiting farms on a regular basis, you're talking about seed currently, there's conversations about fertilizer as the year starts to conclude. We always recommend that you pre-plan your credit portion to that call as well to make sure you have a strong understanding of their business. So prior to that call, questions to ask yourself is, what did the grower purchase from your business last year? Was it just seed? Was it fertilizer? You're looking to expand that. What's the trend? How have they paid as well for those purchases? Did they pay cash? Did they pay with credit card? Did they use FCC in-house FCC financing? Was it in-house accounts receivable? How have they paid for those purchases in the past? And what was the timing of those repayments? If you offered them credit and they were 60 days late for repayment, why did that occur? And also, what's changed year over year? We know that profitability is going to be maybe with what Sarah mentioned earlier, it might be a little bit restricted this year compared to other years. So really having an understanding to what's changing year over year. They may have expanded as well. They may have acquired 5,000 more acres, and that would also play into your overall conversation. So what we have is some questions, and this is something that the FCC team, I'll give you the list of contacts that you have, but this is how we can work with you as a retailer to support your business. One of the areas is helping the planning for those conversations. Questions we recommend asking is, how does the customer plan to finance their inputs for the upcoming year? Again, are they paying cash? Are they paying credit cards? Are they doing loans? Have they set a budget for input costs for the year, and how do they plan to manage those through the season? Are there any specific times of the year when they expect cash flow to be tight, and how do they plan to manage it during those periods of time? Questions to ask as well is, how does a farmer plan to use finance options to cover those purchases? What's worked well in the past? What could be solutions in the future? Are they open to exploring finance options? Instead of as a retailer, instead of you taking that risk in that account, is a customer open to other options other than in-house financing? And the other question to ask is, what's the customer's preferred timeline for repayments? Do they need flexible terms? Does it make sense for a grower to have $500,000 due at the end of July, or does it make sense to defer that to a later date? And that's really where FCC can help with their FCC Crop Input Finance Program. And really what it is, if I was to summarize it, this would probably be the best slide to summarize it, is it offers an 18-month crop cycle. So essentially, we can use today's date as October 16th. Any purchase the customer makes through yourself that's utilizing FCC from September 1st, so we use September 1st, 2025, all the way to August 31st of next year of 2026, that payment is not due with us until March 15th, 2027. That allows your grower to, again, we know there's going to be seed conversations happening right away. If they want to utilize the program for seed, they can put their pre-buys on it. If they want to commit to their fertilizer purchase now or in the future, they can do that. Now or in the spring, crop protection, they can get their crop off, get it in the bin, watch commodity prices, sell when they think it works best. They have that flexibility till March of the following year to make that payment. So currently that would be March 2027 for current purchases today. What's really great about this program is anything that the customer purchases next year, so we're talking September 1st, 2026, that won't be due until 2028 with us. So really they can have up to 1.5 years of purchases on the program, again, with that payment due to March 15th, just give them the flexibility to ideally maximize their margins and eliminate having to make large payments mid-season. So when we look at some of the benefits to how the program can really help grow your business as a retailer, there's a couple of areas I thought I'd just highlight today. One of them, it allows you as a retailer to really focus on growth and not collections. It removes the risk of non-payment and eliminates time-consuming past-due conversations, freeing your time to focus on sales. So I've seen it over my career where there's a large balance outstanding with the retailer, and now you need to think about what's coming up in the future, but you still have money outstanding. How do you manage those conversations? That's where we can help. The customer has the loan outstanding with FCC, and you can focus on, really focus on sales, focus on the next purchase, and know that you're not carrying any sort of risk for that account. And it really positions you as well as a trusted partner by offering flexible financing options. It positions your business as a solutions provider, which is definitely important on your day-to-day. Some other benefits as well as it provides cash flow freedom for your business. Again, it eliminates collection delays. It means that you get paid up front for the product versus delaying or waiting for that payment. It completely reduces your bad debt risk. This is a huge benefit of the program. If the account falls past due, if it's 8 months down the road and that account hasn't been settled with FCC, we're not going back to Mark Davey and Terrico and say, hey, Mark, this needs to be paid out. We carry that risk. It's our risk. We manage the collections. We don't even get you involved as a retailer. You focus on sales. We'll take care of the back end and make arrangements with those customers. And really, it helps enable growth as well. It provides a tool for the customer to make those purchases now versus down the road. If it's in season and they want it, for whatever reason, there's costs that need to come up. That gives them the ability to make those purchases here today. From a customer perspective, the benefits would be for sure flexible payment terms that due to March 15th gives that flexibility to get their crop off, get their crop in the bin, maximize profitability. It can definitely help improve customer confidence. We mentioned earlier that growers, when they have credits up in the background, there's that emotional benefit that they feel. They are comfortable having a conversation with you as a retailer to talk about their upcoming needs or requirements. With the credit in the background, when it's good to go, they can have those conversations with you quite easily. And it helps enable timely purchases. It gives them access to the seed, it gives them access to fertilizer, it gives them access to crop protection products at the time when it's needed, which will help them improve their crop performance and profitability. A couple other slides I just mentioned. A bit of a myth that we hear I know I've heard it over the last couple of years, or what's a sufficient credit limit? We've heard rumors, it's $100 an acre, it's $150 an acre with FCC. We don't have a number. We're going to base our credit limit based on what you submit to FCC as a request, which I'll review in a second, but it's based on the customer needs. So if that customer needs $1 million for inputs for the upcoming year, that's what we would recommend that you set up their limit at, so we can get a limit in place to meet their needs to allow them to make those purchases through the season. We've also launched as well our online application process. So one of the main focuses that we've worked on is to make the process to sign a customer up with our program as easy as possible. We have an online portal currently where, as a retailer, they're speaking with a customer and they're looking to utilize FCC. As a retailer, you submit the request. All we need at FCC is a name and a phone number. The customer gets an email. They complete their application on their phone or computer. It'll take about 5 minutes. They hit submit. In many cases, they're going to get an auto approval, meaning that they're going to get an answer within 30 seconds, followed by the appropriate documentation from the sign on their phone. I've seen examples where from the application to approval to having it set up in the system, that could happen within half an hour if everything flows quickly. So the main feature to this is everything is done online, everything's digital. We're taking the paper out of it. Our goal is to make the application process as easy as possible for yourself as a retailer and also for the customer. There is a support team that you have available at FCC. We have our inside sales team listed here at the top right that manage where they work with retailers through the country. We have Sarah, as spoke earlier, Sarah Dobson, who manages our corporate partnerships in the West. We have Mark Beaudry, who handles our corporate relationships in the East. And then we have 5 territory relationship managers like myself spread across the country that really our goal is to work with yourself as a retailer and look to find solutions to best serve your business and provide as much value as possible. So that could be strategies, that could be conversations about maybe we're linking you up with our team for lending, for corporate lending, all sorts of strategies that we can work with. Maybe it's a training session with your staff. Maybe it's a credit conversation, giving you the tools to be successful. That's what our team focuses on, and that's something that we'd be more than happy to work with you going forward. And that concludes my portion of the presentation. Definitely open to having a conversation or open to any questions that you may have.
There was one question in the chat, Steve. I see it now is what number did you use for current ratio as a benchmark that FCC is looking for?
Oh, I'm sorry, 1.25%. 1.25. Not percent, 1.25.
Thanks.
Yeah.
All right, so now thank you so much both to you, Sarah and Steve, for your presentations. But what these Care Connect sessions are about is really you have these experts in the room, and we'd love to have and engage a conversation with you and to learn more about questions from the retailers or questions from those attending. So either just put your hand up or raise your hand and ask a question, engage in a conversation, or if you don't want to put your hand up and ask the question out loud, definitely put it into the chat. Any questions at all or things that you have, both Sarah and Steve here, even if it was maybe something different than their presentation? I know that's what we're here about is input financing, but if there's something else related to Farm Credit Canada, by all means, they can try to help with that. But anything else around risk management that we want to discuss? Farm financial health?
I will let everybody know on the call that FCC has an economics website as well. I provided a very high level overview of what we're seeing in the market. But if you sign up for any of our knowledge newsletters, we've got some great information that our team shares on a regular basis. You can log on and sign up to receive those if you're interested.
And they would find those just on the website, Sarah? Is that what you're saying when you say log on? Or
yes, I will put the link in the chat. It is FCC's economic webpage, and again, you can sign up for what we call the FCC knowledge articles.
Okay, perfect. David, I see your hand.
Well, thank you both for the presentation. It was very informative and very educational. Looking at some of the trends on the economics slide, we're seeing a decrease in farm income, we're seeing a decrease in profitability, an increase in land prices, what sort of defaults on credit are you forecasting to see coming for the end of 2025 and going into 2026, even with the reduction in the basis points by Bank of Canada?
Sorry, that's a really good question. And thanks for asking, David. Now, Steve and I both work in our input financing division, which would be separate from our egg production division. So egg production is a team that provides farm, mortgages on their land, a number of different things, where Steve and I are really focused on that input capital. With regards to our business unit, we saw a slightly higher default rate this past spring, but still very well within, our 5 to 7 year average. When we look at our input credit, we know that this is the only place that growers are using it, is to actually buy products. And it's one of the first things that does get paid down, given that they need to reopen it, to use it again to put a crop in. We know that farmers need to see the next crop to, keep their operation going and have a chance at being profitable or recouping some of those costs. With regards to our egg production division, I'm not sure of those numbers. We could probably take that away and see if we could get back to you. I know that when we look at our overall book, we are still seeing a significant amount of equity, across the industry. We also know that, there are people who are in a challenging position, and thankfully, in most cases, we have the ability to provide them the tools to get back out there and, try to farm for another year and make the changes that are needed to put themselves in a profitable position. So I'm not sure, but I can see if we have any information, if we have any default projections. To go a little bit off topic, but in, a similar vein is, we talked about some of the challenges that we are seeing on farm. If you listen to FCC on any of our social media channels, or if you've heard our president speak recently, she talks a lot about our ability or our need to focus on productivity and efficiency, and how are we going to do that. FCC has made a commitment of investing $2 billion through 2030 to advance ag tech innovation in our industry. We see this as being really important to help supporting the growth of our nation, and the ability for our farmers to continue to compete on a global stage. So you might hear FCC talking about, investing in funds, direct investments, across from those pre-seed startups to later stage enterprises. We've, made a few press releases over the last 6 months. We just recently released an innovation report. So although we are highlighting that, yes, there are challenges, we also think that we're very well positioned, to be kind of a cornerstone partner to help develop those ag tech innovations and bring them to market.
Well, and I guess the reason I ask, Sarah, is, and speaking specifically to the area that you and Steve are in, have you seen a sudden change, either positive or negative, in applications for FCC crop input financing? And what I'm leading up to is, all of a sudden, are you seeing borrowers surging towards FCC because traditional avenues of lending, whether it be through the credit unions, the big banks, Scotiabank, other lenders, suddenly are tightening up their credit, leaving FCC as the only option for some of the retailers?
I know that we had a very robust application season this spring. We always have a busy spring season. I think our kind of spring season this year lasted the longest that it ever has in terms of a record number of applications. So I'd have to dig into some of those details, but what I can tell you that we're starting to see already is that farmers are leaving their balances on FCC's line longer than they have in the previous 2 years. What we saw in the past 2 years is we saw stronger cash flow on farm, as well as higher interest rates. So growers who did have cash were paying down, those operating lines or input financing lines sooner. And we're definitely starting to see that trend of customers leaving their balances on FCC through, to that March 15th due date, and taking advantage of the flexibility that our program offers. So we're starting for sure to see that cash flow need show up a little bit in terms of how long those balances are on our accounts.
I can just add something if that's okay to that as well, is what we've seen as well is, I wouldn't necessarily say we've seen for a number of years, and it still happens today, as much as we would like to say that, partners aren't, or retailers are not carrying any sort of in-house risk. The reality is it's happened over the last number of years. And what we're starting to see now is, now that we know that the economics maybe aren't as positive as maybe they would have been over the last couple of years, we're seeing a higher number of retailers looking at their account receivable and saying, is this worth the risk for us to carry? Like, they're not a bank. You're not a bank. Quite often, the lending decision is made, and it's based on that relationship with the grower. So we're starting to see I'm seeing it regularly where partners are contacting us and saying, hey, like, we need to revisit the strategy. We're not interested in taking that risk, and we want to look at options that make sense for the customer. So we're definitely seeing, I would say, from partners that weren't as larger before, we're starting to see more activity from them, just because, again, they're not a bank, and $500,000 hit can definitely hurt, and retailers are looking to defer that risk and utilize the program to help with that.
Well, especially if you're a retailer and you're paying for a line of credit, and your margins are thin to begin with, it doesn't take more than a bad account or two, and then all of a sudden you're upside down.
Yes.
And that's very hard to get out of, especially with pre-buy programs with some of the suppliers.
Yes.
And other places where your money could be better spent.
Exactly.
So,
and just to add to that, and to have that conversation, we deal with it from time to time where Farmer Joe owes $1 million from the previous year. Now they're looking at buying in the spring for their operation. It can put the partner in a bit of a difficult situation. How do you say no if you've done it in the past, kind of idea? So this just eliminates the risk and lets you focus on sales and the good stuff that you guys work on, and let us manage the credit side.
okay. If I may, I've got one further question. I don't want to
Please.
monopolize everyone's time. So you mentioned the investments in ag tech, and I've noticed this has been very popular right now. We're seeing a lot of the credit unions that say they're investing in ag tech through their incubators. The biggest problem I have is getting a definition out of people. What is the ag tech that everyone is investing in? And what is the expectations of a return? Because putting money out there and saying you're investing in ag tech, there has to be a return on investment. Otherwise, it's just money going out the door. What is FCC's goal with lending this money for ag tech? What do they see for efficiencies, productivity that they're helping the industry with?
I don't know what the metrics are. We have an entire team dedicated to this. Obviously, Steve and I don't work in that area, so I would not know exactly, what they're looking at in terms of what qualifies as a project, how large of an investment they're willing to make. I know one of the key things that FCC looks at when they're able to work with some of these new technologies is how can we create an ecosystem to help this venture be successful, right? So it may come in the form of financing, but it may come in the form of knowledge, market access, access to tools like our input financing program. So I know we're really focused on helping provide an ecosystem of support, but in terms of the actual metrics and the return that we're looking for, because of course we do still have shareholders as the federal government, I don't know, but I can see if we can gather some of that information and get back to you on that.
If you wouldn't mind, I would appreciate it.
Okay.
So thank you
Do you
both.
want to throw your email or you can email me privately so I have your contact information My name is Sarah Dobson at FCC.ca, and then I can have your contact information to get back to you.
For sure. Thank you, Sarah.
Perfect.
One of the things just of interest at the CARE convention on the Thursday morning, as we have a panel called Harvesting Innovation, the Future of Ag-Retail. And so Mo Yagi, who is with Farm Credit Canada as the Vice President of Innovation, he's going to be speaking on that panel. This is sort of one of those questions we're going to be engaging in and talking about is also with CANE, which is the Canadian Agri-Food Automation and Intelligence Network. And joining us from there will be Garson Law, and then Scott Day with Fall Line Capital, who does venture capital investments, but is also a farmer from Manitoba. So they're going to be having a conversation about some of the technologies that may be disrupting ag retail in the future, or crop inputs and farming, but also what are some of the investments and up and coming new innovations that, you know, potentially FCC is investing in, as well as some of these other organizations and what they're seeing coming forward. So anyway, it's just going to sort of build on that one part of your question there about the 2 billion investment in innovation. Not that that relates to input financing, but I just thought I'd add that in.
No, I appreciate that, Myrna. Actually, very much dovetails into, you know, things that FCC is doing, and they could speak better to, you know, some of these topics. So.
Yeah. And so with that panel, it'll be engaged with the retailers in the room. I think we have already over 50 ag retailers registered to attend, and included with all the other people attending. But yeah.
Great.
Mark, I see your face. I'm not putting you on the spot. Anyone else? I just see initials. I don't see names, but if anyone has that opportunity to ask a question, or Kent, I see your name. I'm not pointing you out. I was just trying to, if there's something, I can quit talking and you guys can ask questions or engage in something with both Steve and or Sarah or each other.
Besides independent retailers using third-party financing with FCC, who other partners are you working with? Just so I'm aware or understand who all else is using this flexible financing that's available to us. Like are co-ops using your financing as well?
We would have a number of partners, you know, across Canada, coast to coast to coast. The two large partners that we do not work with would be Nutrien and Richardson. Excluding those two large partners, FCC probably works with almost every other retail partner across Canada.
So Richardson uses Roba Bank, if I understand correctly.
Bravo. Yep.
Bravo, and Nutrient does what, their own in-house?
I believe they have a partner that provides them with what they brand as their own in-house solution, or a mix of. But Scotia would be their partner in terms of developing that tool with them or for them. I'm not sure exactly the details, but.
Okay, just curious.
Yeah.
Yes. And I'll just give you a scenario. I should know the answer to this, but I just, maybe somebody else might be curious like me. But so let's say, you know, we got a grower that owes money for us at the end of July and plans on paying us at the end of July, and, you know, Mark gets busy and forgets, and it's almost the end of August and realizes that the farmer never paid. And he has financing already done up with FCC with us.
Mm-hmm.
Is that a problem? Like, is there a time limit on when
Nope.
we can? No. Okay.
No. Within reason. Sorry, sir. I'll answer this one. Within
you can't
reason.
go a year later, right?
Yeah, if we're talking December and they owe you from 2023, not eligible on our program. But if it's a purchase that they made in, say, April, May, and you're wanting to put it on in August, that wouldn't be a problem.
Okay.
If you wanted to put it on, say, September or mid-October, October 16th, we would just ask that you reach out for obviously that I'd be your contact for that, and then we would just adjust the date to have that payment due in March of 2026.
Okay.
So what we're trying to avoid is where we can create challenges is having multiple crop years come all due at once. So that's why we would adjust that date. If they bought it in the spring or summer, we want to have that due next March.
Yeah, it makes sense.
Yep.
I figured that was the case, but
And you can transfer the balance over to FCC for products or services, but not any interest that you may be charging the customer, right?
Right.
So if you
Yeah.
carry it from, April to August, you can
Right.
place that, disbursement on FCC for the principal products or services only.
yeah. Just a comment, not really a question, but I think I set up 2 new growers this past season on FCC. I can't stress enough how quickly it was handled. It was incredible. Like, I don't know if it was the same day, but it felt like it.
Right,
So,
yeah.
you really got that thing streamlined, user-friendly way of setting up a new account. And when I do set up a new account, I know nothing about that grower's credit history or anything. And I make it very clear to them that I need to ensure that he has proper financing in place to do and purchase crop inputs from the company I represent, and that he needs to have it approved. And I've really had zero pushback that the process, whatever you guys are doing in the background there, it's working for me anyways.
Good.
Yeah.
Great feedback. Thank you, Mark.
Good to hear.
Awesome. Thanks, Mark. Anyone else before we have a few more minutes? Anyone else have a question or wanting or ask something of Mark or David to build on something that they've already commented on or asked? No? Anything else, Sarah or Steve, that you thought, oh gosh, we never mentioned this, but yeah.
No,
You're good.
other than
Yeah.
if you have questions or curiosities and you think FCC might be able to support you, just reach out, right? Whether that's to someone like Steve or any other team member at FCC, reach out and we'll see if we can help.
Absolutely.
Okay. And Lisa, this recording is going to be put, I think we already commented on this maybe, but it's going to be on our website in the next week or so, or however long.
Actually, no, probably, yeah, no, it'll be up actually quite soon. It'll actually go up on our YouTube channel. And then everybody who registered will get a link to where it is. And yes, they can view it at a later date.
Yeah. So if you need to see those slides again, or if someone else who wasn't able to make it today wants to look at it, it will. I guess we can send a link out, but they can find it as well through our website, or.
You know what? That's a great question. We do not have a link to our YouTube channel on our website, so that is going to go on my to-do list.
Right. I'm always struggling to find things, so I'm just trying to ask those questions that I maybe should know the answers to, but thank you, Lisa. So.
There's lots, but yeah, no, I will put it, so it'll be on our website near all our other social channels. I'll put the YouTube link as well.
Okay. All right. Well, thank you so much. Unless there's anything else I've missed at the last minute here, but you can definitely get in touch with myself or Lisa. You see our contact information there. Yeah, we're always here. Our phones get forwarded to our cell phones, so we can answer questions if you need to get in touch with us. And we really appreciate you joining us today. And thank you so much again. We've been working closely with Sarah and Steve and really appreciate you being able to do this session for us and bring this information to the group.
Thank you so much.
Thanks for having us.
Have a great rest of your day.
Have a great day,
Thanks,
everybody. See ya.
everyone.